G'day, listeners, and welcome to another episode of the Scouting Australia podcast, powered by Australian Property Scout Buyers Agency. I'm your host, Sammy Gordon, and today, guys, I have got an exciting episode. Most people would probably try and take the piss out of tax planning and accounting, but I've got two boys here with me that love it. They love to have a bit of a laugh about it, and I'm excited to be joined by the two drunk accountants, both Dan and Tim from the podcast, Two Drunk Accountants. Boys, welcome to the show.
Good. Thanks for having us on. We don't like to take the piss. We like to have the piss while we're talking about tax planning.
So you like to drink on poddies as well?
Yes, that's right. Unless it's at 9 a.m, that's just slightly too early.
Or right now where I have a green tea. It's a little bit off brand, but it's
not an Irish green tea. It's not an Irish green tea.
Yeah.
A little bit of something in there. A little bit of something. Boys, I'm excited to have you both on. We haven't had an accountant on the podcast before. We're right in time for tax time as well. I've listened to a bit of your boys' stuff before. You've made me laugh, which is surprising from an accounting perspective. But I'm excited to dig into a bit of banter here, boys. Dig into a bit of stuff around tax planning. We're perfect time for anyone obviously wanting to try and get themselves into the correct position heading into the end of financial year. Obviously, the property investors with already properties in the portfolio. And then moving into next year and kind of planning for next year and being potentially a bit smarter about it as well and kind of going about it. So, boys, I'll let you guys introduce yourselves first, where you're from, your kind of background, how long you've been accountants for and everything too. And then, we'll dive into it all.
Awesome. Keen as. So I'm Tim and that's Dan.
Yep.
And so we're partners in an accounting firm called Cats Accountants, which is the animal. Yes, the cat. Used to stand for something else back in the day, a lot of words, and we just shortened it to Cats.
Now it just stands for quality service, right? Yeah.
I can see where the abbreviation of Cats into quality service. It goes.
Yeah.
Sometimes I like to joke that we're called Cats because all the other accountants are dogs. No.
Hey, that's good. I would use that from a buyer's agency perspective. That's the sort of thing I would say. I love that.
Yes, very good. So I've already called all other accountants dogs.
Yeah. Good start, Tim.
We're 30 seconds in, boys, and everyone's a
Yeah. We've alienated all other accountants.
No, I love it. And you boys, you do run obviously the Two Drunk Accountants as well, which is a pretty highly rated accounting podcast out there as well. Do you guys want to give us a bit of a spiel on what's that all about as well, beyond just being about accounting?
Yeah. So, what we do mainly day to day is give small business people advice and help them, especially try and match their lifestyle goals and what they're trying to do, which, property sometimes falls into that.
Yeah.
And we help to get them to match their business to that dream and what they're trying to do. So the podcast is really just an extension of that. Most accounting podcasts or small business podcasts put you to sleep. And we thought, well, let's try and get some, put some medicine with that sugar and give people some good information while also having a bit of a laugh and not taking ourselves too seriously along the way.
Yeah, and I think we really finally decided to do the podcast when we were drunk one time. And we were hey, hold on. Two drunk accountants.
Yeah, this is it. This is the podcast.
Did you record that episode when you guys were smashed or what?
We've done episodes at conferences generally. We'll go back and we're like, all right, let's do an episode right now. And
they're not listenable. They're just terrible.
Yeah, they're actually not that great when you're off your head. You drag on. Drag on. But it is fun. It's very fun. So.
Mate, I've come up with some decent ideas for the poddies. Like co-host of Scouting Australia, Jimmy. Sometimes we'll get on it after a couple of days of recording, and then we'll get on it on a Friday night. We're on the margaritas. We're about eight tequilas down, and we're just like, we'll just come up with the ideas. Thankfully, we don't record it, but then we write them down, and there's generally a little bit of gold in there through all the you wade through all the shit. There's something there. You know what I mean? By the time you get there.
I think our issue is every time we have a drink and do a podcast, we start promising things to the audience, and then we release it, and it's like, oh, yeah, that's right. I told someone to knit them a scarf, or how are we going to do any of this?
Just regrets. Yeah. Basically, it's a dangerous thing. Podcasting whilst drunk. It's you're going to promise things.
We're going to take 30, and I want you boys to go down. I want you to get some grog. I want you to get some. I want to start promising people some stuff.
Yeah,
I could definitely go a margarita right now. You got on mouthwater.
Mate, lucky we didn't do this actually in studio. That would have been a dangerous afternoon, I reckon.
Yeah, it would have been.
The next one we'll do in studio.
All right, sounds good.
Come up to the Gold Coast, and you can show us the local area.
The local holes, drinking holes. Sounds good, boys. Sounds good. All right. Well, look, in the spirit of delivering some accounting value today as well.
We better talk tax, I guess.
We better talk it for a bit. Boys, ATO's cracking down on property investors. Give us a bit of insight, give us a bit of background around what's happening at the moment, why are they having a crack, and who's obviously at most risk from this.
The ATO knows all is really the way to go, is to start this conversation.
They're cracking down on everyone,
yeah,
I'd say.
It's not just property. It's a lot of different other, like if you've invested in crypto, for instance, they've got their eye on you for that as well.
Gig economy.
The gig economy is something they're cracking down on. So it's not just property. However,
what's a gig economy?
So Uber driving, or if you're renting out your caravan, for example, Airbnb. Those are types of things. Or delivery services, I guess, as well. Okay. There's a lot of that happening these days.
So they're having a bit of a crack across the board.
Yeah, for sure. And I think what's really happening underlying all this is that the ATO is starting to getting really good at analyzing the data they get from everywhere. Yeah. So they're getting data from all these different companies. You know, every time you sell a property, they know about it. It's starting to appear on your pre-fill. You know, if you're an accountant or you are looking at what information the ATO has about your tax return, it says you sold a property or your client sold this property with the address this year. Do they have a capital gain? And if you lodge the tax return without a capital gain, they're likely going to send you a letter that says,
it's just a matter of time.
Did you forget something? Because we know you sold that property and it's different to your main address.
Absolutely.
Really, so it's amazing. That closely as well. So knowing there's a difference, obviously, between an investment and primary residence.
Yeah.
Interesting.
Yep. They know.
Yeah.
They know. I mean,
they know all.
They obviously don't know the details. So if for instance, you'd moved out of a property and you're using the 6-year rule around, it used to be your main residence and then you've rented it out for a period and then you sell it, they don't know that that's the case. Yep. And then you just apply that exemption and everything's fine. But they just know enough that they're going to start scratching if you don't give them enough details when you lodge your return.
Absolutely.
Okay. So what would you say is probably the best way to, I guess it probably maybe exactly how you finish it there, the best way to kind of keep your head above water, avoid the guillotine on the neck is declaring things appropriately, right? Like not trying to sweep too much under the rug.
That's right. That's in preparation for coming on to your podcast, that's exactly where my head went. It was like, you just got to do things right. Basically, there's no silver bullet or magic loophole that's going to get you out of paying tax.
We have a unique perspective on tax. Is that tax isn't bad. Tax means you've made a profit, and if the only way you can make a profit is to not pay tax, then it's not a very good investment. Then you've got other problems with that investment than just tax. It's usually a symptom of a problem rather than the actual cause itself.
For sure. And that's, I mean, we deal with a lot of business owners. So and that's from that perspective. And then, and obviously there's the whole negative gearing debate, which is a whole nother topic of discussion. But I think, you've hit the nail on the head there. You should see tax as a really good thing, particularly if you make a huge capital gain. Yeah, you could have $200,000 of tax to pay. But I mean, that means you've made a huge gain on that property. Yeah, that's right. That's right. So, so see the positives. And definitely by the end of this episode, I want to dive into some talk about structuring too, because we're talking, people listening to this episode will have portfolios of properties. So the way you structure your investments could make a huge difference to how much tax you pay.
Yep. Yeah, 100%. No, I'm happy to dive into that, boys, for sure. And look, we are definitely on the same page. Like it's funny when people are like, oh, well, I don't want to sell because I'm going to have to pay capital gains. It's like, okay, so you're not going to sell, so you're never going to bank a profit because like that's effectively what you're going to do, right? But it's like, okay, you make 200 grand out of selling a property or 500 or a mil or whatever it is. You're going to pay tax on it if you make it as an annual income, right? Like you get taxed as a job, but at least we get our capital gain tax exemptions and whatnot, which as of recording right now are still on the table. I know it's been talked about a little bit lately. Thankfully for now, it's been swept under the rug, but it's one of these things, right? We've got those sort of exemptions around which take advantage of bank profits and move on. I'm definitely the same, man. If you're paying tax, obviously we want to minimize it as much as possible. But if you're paying it means you're making money and you're actually profiting off something rather than losing money.
And I think that's the distinction to make is we're not saying ignore anything that you can do to reduce your tax because there are legitimate ways to reduce your tax, deductions you didn't realize you can claim, exemptions to capital gains and things you might not have realized you could have. But once you've done that, if you still owe tax, you got to change the mindset a bit.
Yeah. It's part of cost of doing business, right?
Yep.
That's right. Yeah, so that's point number one.
Beautiful. Point number one, cost of doing business.
Yeah.
I love it. Profit is the cost of doing business. Boys, or tax, sorry.
Yeah.
Moving forward from that, Dan, you were just kind of just talking about like being able to maximize deductions and everything from that end as well. I really wanted to kind of dive into, especially people who are starting out and maybe just got 1, 2 properties, or even people who've been doing this for a while. I remember when I had 6, 7, 8 properties, something like that, I realized I didn't realize until I started working with a property specific accountant, someone that really knew what they were doing from this front. Things that I was missing and things that I hadn't been declaring or maximizing or claiming or whatever. What are the biggest things that you see that are missed? Sometimes they're the most simple things under the eyes, but like, what are the biggest things that you see that are missed, from property investors every day, every year, when it rolls around to tax time?
Yeah.
I think depreciation.
Absolutely, depreciation.
It's probably the number one.
That was the biggest one. That was the biggest one that I missed back in the day.
Yeah.
Non-property specific accountant. He didn't tell me about it. Yeah. Thankfully, I could do a 3-year clawback on it. But
and that's the thing. I was just about to say that there is a time limit on how far you can go back and amend your returns.
Yep.
The ATO sometimes is willing to see reason and let you go back a little further. So I had a friend do the same thing. He had an apartment, and it was fairly recently built.
Okay.
He could have claimed heaps of depreciation on that, and he had like 3 or 4 years where he was paying tax on, or getting lower refunds than he should have gotten on his tax return.
Yep.
So thankfully, the ATO saw a reason and let us go back and amend them all.
Really?
But
how far back did they let you go?
It was 4 years. It was 4 years. So I think generally they really only let you go back 2.
2, yeah. These days, 2.
I've had the opposite experience recently.
Yeah. So, I mean, and this is the thing, and we'll dive into this a bit too with record keeping and when you're claiming deductions and things like that. It can depend who you get on the day with the ATO if you're lodging a request for something like that.
Yep, that's right. It can feel unfair, but that is the way that the cookie crumbles. But broadly speaking, though, depreciation, you should go get a depreciation schedule. There's many great businesses out there who do that.
Definitely.
And we can claim 2 types of depreciation. There's the depreciation on the equipment and the assets that are inside your building, and then there's the depreciation on the building itself.
Yeah.
The depreciation on the building itself is usually a very small rate over a very long period of time. And it does actually affect a little bit your capital gains tax at the end of the day, but you're getting an immediate cash back is a way to think about it by claiming it in your tax return now.
Yep.
Yeah. One of the companies we like to refer to is MCG Quantity Surveyors. So they're really good because
awesome. Big Mike been on before, mate. Everyone loves Mike.
Yeah, he's a legend.
He's
great.
Actually, he's from your neck of the woods as well, isn't he? He's a Port Macquarie boy or something, isn't he? Something like that.
Yeah, he is.
He's driven here in his Ferrari or whatever it was.
Wait,
what's a Ferrari?
It's Lake Macquarie, isn't it? He's
Lake Macquarie,
That's
yeah.
right. Not Port Macquarie.
He's at Lake Macquarie. He's a good guy, Mark.
Great guy. But yeah, I mean, if you're unsure, you just got to contact them. They'll tell you whether or not it's worthwhile getting one.
Yeah.
That's what you want, because a property that's built before a certain year, which I believe is like 1986, around about that time frame, won't possibly generate much depreciation for you, and therefore it may not be worthwhile. Which is why investing. People talk about building a new property or buying a recently built one or an apartment complex that was recently built, because there's a lot of depreciation.
A lot of concrete gets depreciated over time on those things.
That's right. Yeah.
Definitely. Yep. If we dive into that for half a second as well, if we talk about like let's say the renovated versus unrenovated product, and if people want like a real big deep dive on this, you go back to, I think it's depreciation, or depreciate like a beast with Magic Mike Mortlock. It's something like that. It was at the end of last year, guys. Google Mike Mortlock in the poddy, or like look at him in the poddy. He'll come up with that episode. But boys, if we dive into it for half a second as well, if we look at, say, like properties that are renovated to unrenovated, and like you buy it renovated or you do the renovation yourself, what's the difference there? Because a lot of people kind of get these waters muddied because there was a change that came in from 2017, 16, 17, 18, something like that, where these laws have changed. Can you boys break this down for us as well, so that listeners get understanding?
Yeah, there was a change to the rules around if the assets were new or new to you or secondhand, and whether or not you're allowed to depreciate those.
Okay.
So, for instance, if a very simple example, if you have a rental property and the oven breaks and you buy a second-hand oven and you put it in, you can't deduct that.
Okay.
But if it's a new oven, you can depreciate that over time.
Yep.
Yeah. So if someone else has just renovated, they've put in a new kitchen, there's going to be a lot of plant and equipment in that type of renovation.
Yes.
So you're talking cooktops, ovens,
Range hoods.
Exactly. Yeah. Therefore, you're going to lose out on the depreciation for those items.
Okay.
Whereas if it's more of like a deck that's been added on and that's been done before you bought the property, well, there's probably a large capital improvement there that's not an asset, not plant and equipment. So you can write that off over 40 years.
So it's part of the building structure, not the not the plant and equipment, which is your kitchens.
And it's very tricky to draw a line between those two things sometimes as well. And we always, I definitely always have to check. There's a whole list the ATO have, and so sometimes something you buy for your flooring could be plant and equipment, or it could be capital improvement.
100%.
Yeah.
So whether it's fixed or loose, right, on that front.
That's sometimes.
There's not much rhyme or reason. We've got to check the list.
There's not much rhyme or reason to the tax rules. I mean, have you ever tried looking up what has GST on it and what doesn't? It's ridiculous.
The ATO's rhyme or reason isn't in their vocabulary.
We're talking like bread versus finger bun. Finger bun has GST. Bread does not. That's what we're talking. But yeah, so
what an analogy. Social media guys, make sure you pull out that one out, the bread versus the finger bun. That's gonna be the take of the week. That's the best.
I'm hungry now.
So am I.
We need a margarita and a finger bun.
Hey, what a mix. Would you dip it in bud or not? Just soak a bit
that
of
might be too far.
some of the chili flakes in there, the chili margarita.
Oh, spicy mug.
Spicy.
I'm on the second one already, boys. We've gone past the...
I had a porn star martini on the weekend. It was delicious.
Where are you at?
It's great. Arc. Terrible. They bring out a little thing of Prosecco. It's delicious.
Wow.
There we go.
Yeah, so there's a good segue there because a deduction
that's some martinis or
yeah.
Where are we going with this?
Let's talk about how you use your property. Yeah.
It took Tim a second for that to click with him, man.
Yeah, it did.
All right,
we've done a whole episode on that.
Let's keep it PG.
We have done an episode.
Finger bun in the margarita. Let's keep going.
Yeah, we've done a whole episode on the adult industry actually, which was a fun one.
Tax consequences
and how you've got to keep a
Did you actually?
Yeah, we did.
No way. Were you with someone? Like, did you do it with a?
No, just us. That is a good idea, though.
Come on, boys.
No, we should have.
That would have been great.
I think we were too embarrassed. We just did it ourselves.
We were blushing the whole time.
And you had one foray in and you flopped and it never happened.
Exactly.
We'll have to revisit.
Okay.
Tim, what were you saying?
The segue is some people may have made some large repairs or potentially improvements to their property in this financial year, and there's often some confusion around that when it comes to speaking to your accountant. So obviously most people doing that type of work to their house, they think they can claim that on their tax. And they're expecting a really large refund because they might have spent $30,000 replacing the roof. And people think of a replacement as a repair, but it's not the same thing. And again, this is a highly complex area that even accountants have to really think long and hard about sometimes and look up ATO lists. But the main thing you've got to take away from this is there is a really big difference between an improvement and a repair. Would
you also say in that scenario there where you're talking about a roof, right? Like it's obviously it is a repair because you had to do it, but at the same time it's a capital improvement which is added to the structure and you've rectified something. So again, this is where you boys are going to. This is why it's being added to the capital base and being depreciated over 40 years as opposed to an instant write-off in 1 year, right? Sorry, mate, go for it.
I was just going to say the ATO will generally say it's if it improves the form, so the way it looks, or the function.
Okay.
So if you're improving the form or function of something, then it's not a repair; it's an improvement.
Okay.
And and there's really not much margin there. So
and there's also a difference between, let's say that you had a tiled roof and you just replaced 20 tiles.
Which I have to do to my roof soon.
Yeah.
That's a repair.
That is
That is definitely a repair.
But if you replace the entire roof, Yeah, yeah. Tim's checked the list before he's done this.
Double check. But
Yeah,
if you replace
check
the
it
entire
out.
roof, that's obviously where it's a full
Yep.
replacement, right? Improvement.
That's right. Yeah. Yes. And so it's those words that really trip you up because you're like, well, no, I'm replacing it. It's a repair. I had to repair my roof, and that involved replacing the whole thing. Like, well, no, it's probable we have to depreciate that over 40 years.
Yeah.
It can be a big hit, hey, that you obviously don't get to see back for a while. I guess it's one of those
Yeah.
things as well. It's again, we talk about cost of doing business, like we did before about obviously about banking a profit. It's one of these things. It's unfortunately it's part and parcel of owning property, right? It's bricks and mortar, and things break and things wear and tear and all the rest of it.
Yeah.
So it is part of it.
That's right. True. And that's where people come in talking about new properties and apartments as well, because it's like, well, it shouldn't break for a while, right? But yeah, it's interesting. And yeah, I think like that's definitely something you've got to keep in mind with your property. Another interesting thing too is like, and we see this all the time. People send through their list of deductions for their property.
Yeah.
New hot water unit is on it. That again isn't a repair. That's a new asset that needs to be depreciated.
Is that written off over a different time frame though, because it's plant, right? Plant and equipment.
That's right.
Okay, so what's the sort of time frame? Let's say AC unit, hot water system, dishwashers, those sorts of like bigger ticket repairs without being 30 grand. How is that different? How is that depreciated?
You won't believe this, but there is a list, and it details the useful life of these assets, and you can depreciate them over the useful life. So if you've got a hot water system and expected that kind of thing will last 5 years, you depreciate it over 5 years.
Okay.
Whereas if you get an aircon unit, that might be expected to last 10 years. You do it over 10 years instead.
You can actually self-assess the useful life of your own assets as well. It doesn't happen very often, but it is allowed.
It is
You
allowed.
don't have a reason to do it, but
you have to justify it if they ever asked.
Could that ever trigger an early audit, or not really? Not unless it would only be more if they looked. If they
in the business, in like a company tax return, there is a question: have you self-assessed the life of any of these assets?
Yeah,
but I don't think it's in the individual tax return in the rental depreciation schedule.
Don't think so.
Interesting. Yeah. Very interesting.
Yeah, and just on the depreciation trend, because this is like depreciation is the main one, right? I mean, everyone knows claim your rates, claim your interest.
You should set up a depreciation arm, and we'll send Mike Mortlock. We'll send him.
Cat's depreciation.
That's it.
No, we'll leave it to Magic Mike because
he's the king of the depreciation. It's fine.
All right, guys. So you heard it here. If you want more on the depreciation side, I'm going to ask you one final thing about the depreciation side. But if you want more on the depreciation side, there's like a 45, 50-minute app with Magic Mike back in August, September or something last year. Go check it out. It is actually a really good app. A lot of people loved it. But the last question I was going to ask you is something we do a lot of the time is we might go in and we buy an old house on a bigger block. We'll do the reno on the front house, and then we'll build, say, a granny flat out the back. Now, we understand from what you've just run through pretty closely in terms of what we can and can't claim out of the renovation side on the front house. But let's talk about the granny flat, right? Brand new build. You were talking about it before with new apartments and stuff. We don't agree with them at all. So I'm going to dismiss that as an investment option. And then if we then convert it into, say, like the granny flat out the back, run us through how that would work from that perspective, and like how much someone could expect to be able to claim, say, in year one from that side as well.
Yeah, well, it follows the exact same rules that we've just been speaking about. Okay. So you build a granny flat out the back. Yep. Well, that is a building. Mm-hmm. So you can claim the capital works deductions on that building over 40 years. Yep. So, you can work that out. Divide the cost by that, and that's what you can claim.
There is a lot of plant and equipment that you've bought, obviously, that's gone into it, and that's where Magic Mike comes in, because he'll go through that property and break it down for you in a nice, easy to digest report.
And they do break it down into like the ceiling fan, the oven.
It's amazing the detail they go to. So the accountant loves it because they just need to look at the report and go, yes, that is the depreciation. Whereas imagine what your accountant would charge you to come out to your new granny flat and check out all the plant and equipment items that you can depreciate.
Or if you just, give them a box full of receipts to be like, here's everything here's the cost of it. And now you've got to go through these receipts and be like, all right, that's an asset, that's plant and equipment, that's capital works, that just takes forever.
Key distinction to make with something like that, though, Sam, is that you can't start claiming depreciation on things until the building work is finished and it's available for rent. Okay. So the asset must be installed and ready for use before you can claim depreciation on it. So if you're doing a build over a financial year, so let's say we started building that granny flat in April and we're still going in August.
Yep.
Then there's going to definitely be expenses from April to June that we're going to have to just keep track of and use in the next financial year for depreciation.
Okay.
We won't be able to claim those yet.
Also, if you buy a property and you do a bunch of repairs to it, not improvements, not new assets, but you just repair it, you just touch it up before you start renting it, none of those things are a deduction either, because it's before the property was available to rent.
Let's dive into this, boys. I like this one. Let's dive into this. I appreciate the stuff on the granny. The granny's good. Yeah. We're all sorted with that. Guys understand where we're going with that. Let's talk about renovating it pre being available for lease, right? That's what you're saying.
Yeah, correct.
Yeah.
So any expense that you incur before a property is available for rent, actually, let's take it a step back. The overarching rule to claiming any deduction against your rental property is only while it has been rented or available for rent.
Okay.
So if you buy an investment property in August and you do some repairs and things on it for the 2 months, you move in, you paint the walls, you do a bunch of things, and then you start renting it out 2 months later. All of those expenses, your interest on your home loan, the repairs and maintenance costs, the council rates apportioned in that period that you may have paid, none of that is a deduction against the income that you've earned from that property for when you did rent it out, because it was before it was available for rent. You can capitalize some of these expenses though, which means it will reduce your capital gain at the end. So still keep track of those costs.
Okay, so if you bought a shitter and you had to go in there and go, Tim's starting to get a bit of the terminology I'll throw around here.
I'm looking for a shitter. That's what I'm going to buy.
I actually found a shitter online the other day. I thought about buying it anyway.
There we go. Right. So Dan's gone and bought his shitter, right, that he saw on the weekend. Dan's gone and bought his shitter. It's stuffed, right? And he needs to put in new kitchen, new bathroom, paint floors, give it a nice spruce up all over. That whole thing is going to be added to capital works, and we can add it to the back end. If we were to sell it at the back end, it all gets added to the back for a CG, like capital gains tax discount. That would be the preferable option rather than being able to claim or depreciate it during the process, right? So even though you've bought it and you've done the works, we can't even depreciate it at that point.
Yeah, correct. Because, you've still got to draw the distinction between an improvement and a repair. So we're talking about repairs here. And so you're really getting punished for making repairs on the property versus an improvement, which is weird, because if you made the improvement, you could depreciate it, just not for the period of time that it wasn't available for rent.
So once it becomes available for rent, you can then start depreciating the assets which you renovated.
But if it's a repair,
you can't.
Then on the flip side, the ATO goes, well, Dan, you knew it was a shitter when you bought it. You knew you were going to have to incur the expenses to repair it. Therefore, it's going to add to the cost base, and you can only claim that against the capital gain at the end.
You knew you had to paint that turd.
You had to spit polish that thing.
All right. But there is definitely question marks over if you could buy a place that's livable, rent it out for a period of time, and start to make the repairs later, that it's probably deductible. I use the word probably.
As long as the property was available to rent while you did the repairs. And maintenance. So if you're just painting a room and a painter comes in and does the job and the people still live there, claimable.
Okay.
If you kick them out for a month, do repairs and maintenance, it's not available technically.
Something is a bit of a lesson on this as well, guys. The way that I would look at this is, if this is something that's going to be a capital growth play for you. So just for you boys, for some reference, we do bread and butter deals, right? So bread and butter deals for us are growth properties. You might buy a deal, try and time an exit in, say, 3 to 5 years once the market's gone through significant growth. Might buy it at a discount, and in this scenario, maybe do a reno. If you guys were going to go down that avenue and it was a growth play, you knew you were going to flip out and sell this thing, it's probably perfectly fine to fit this within the strategy to do it and try and angle everything towards a capital works, so you can just add it to the back end and then claim it off your capital gain on the back end. But if you were going to do if this was a cash flow deal and we're going to be building a granny flat, the way that I would be doing this is, let's buy the site. Let's just get a tenant in there. As long as it's livable, let's get a tenant in there. Let's start the process of building the granny flat out the back. And then when we're coming towards the finish of that, or even as it's going through, that first tenancy is coming off, plan everything for the renovation, and so as soon as that tenancy comes off, you knock over the renovation, and then you're able to depreciate it, right, over the long term. And the reason why we want to do that is because if it's a cash flow deal and the intention is never to sell it, there is no purpose in adding it to the capital base at the back end, because we're never going to be able to claim it back. But instead, if we're doing it on the way through and we're able to depreciate it over the life of it, combined with the granny depreciation, you're going to get a really good write-off sort of claim back on a very positive cash flow asset, rather than something that we're never going to be able to claim at the back end.
Sounds good to me.
You boys like that?
Definitely.
That's a good summary.
Yeah, you absolutely nailed that.
Yeah. So Dan is now. So Dan is now going to rent out his shitter. He's going to put plans in. Nah, that's cool. That's cool. No, I was just kind of like consolidating it. It just kind of got into my head there, a bit of an idea around that. So that's really cool.
No, nailed that.
One other thing I want to add to this, and take it in a new direction here. Interest.
Okay.
A common mistake I see people make with interest is it's not what you've borrowed against that makes the interest claimable. It's what you've used the money for that makes it claimable.
Yeah.
So what do I mean by that?
Yeah, give us an example.
So let's say you have an investment property. And this is the easiest example to give. And you refinance it. You owed 500. You took an extra 100 grand out because you needed to renovate your own home or something. Well, guess what? 1/6 of that interest is no longer claimable, even though you've financed it against your rental property. It's not that it's against that property that makes it deductible. It's that you used that money for a non-deductible thing.
So it's the purpose, right? Like what you've used it for.
Correct.
It's either for that income generating asset, which is tax deductible, or the non-income, the primary residence is not, right?
So a great example here that I've seen happen a couple times is, let's say someone was rent vesting, and they had an investment property. It got some great equity in the last few years, and they thought, you know what, I'm going to go buy my own home now. So they refinance their investment property, and they take out 200 grand, and they go use that 200 grand as a deposit on their own home somewhere else. So they now think, well, it's all investment property interest. I can deduct that. No, you can't. For the same reason as before. It's that money is not used for that investment property. You've just used it as security. So it's where the money comes from, because it happens quite a fair bit.
It does happen a lot.
Yeah.
It's, all sorts of strange scenarios end up happening, and you don't really think about it until later. And then you go to your accountant, and you're like, yeah, I'm going to claim all this interest. They're like, well, hold on. I know it's secured by your investment property, but what's this big drawdown you took?
And so would you say the best way to kind of plan for this, obviously, is having a separate, like if you were going to use it for something that was non-tax deductible, and similarly, if you're going to use it for something that is tax deductible, so if you're going to pull it out of your primary residence and use it towards investing, keep it as a separate equity release. So it's very straightforward, right? It's very
clear.
Yeah, very clear cut.
Here is the interest from this portion, and that's deductible. And that's a great example. The opposite of what I said is true. If you've taken the money out from a non-income producing asset and used it to buy an income producing asset, you can claim the interest on that portion.
So here's an interesting one. Let's use an example. You've refinanced your property because you bought it a few years ago, and you've got equity in it now. And but to give yourself flexibility, you're just going to pull the cash out, sit in an offset for a while until you find the right shitter to buy, Dan. Unless you're going down the income, the cash generation route. But you're going bread and butter. So you're looking for a shitter.
I'm looking for a shitter.
And anyway, if you then 6 months later use the money out of the offset account to put down a deposit on a new property investment.
You said shitter.
Said shitter that you found. Is that going to actually be tax deductible? The cash that was sitting in the offset, that really you've borrowed more in the loan or your main residence.
So we do a segment, Sam, on the podcast called Tim's Think Tank, and I
feel
think
like
Tim's
we're in Tim's Think Tank right now. I feel like I'm in
it. This is a great question, because you're not borrowing.
You're refinancing your house. You're sitting cash in an offset. That you then happen to use on an investment, but your loan is just interest all for the main residence, isn't it?
So it's not, you haven't taken the money out to then go buy an investment at that point. You've taken the money out and you've just sat on it.
Exactly.
And now you're using it for that purpose. Is that a tax deduction because you're not redrawing on the loan?
So circling around to Sam's point, split the loans.
Yeah.
If you're going to do something like that, split the loan and make it specific.
Your example was actually keeping the loan as it was and lifting the balance instead of getting a new equity release.
That's right.
Yeah, terrible
yes.
idea. Yeah, perfect. I like the second one. The think tank.
People do it.
We got the juice. We got the juice going.
But I mean, yeah. So sometimes it's not quite as simple as just a whole new loan for that investment property.
Yep.
Sometimes we see people with 2 loans and 5 investment properties.
Yeah.
So as much as you can, if you're going to be using cash from one investment or your main residence, then split out a new loan so that you can track the interest on that.
Yep.
It is possible to apportion interest and calculate it that way, but where it can be more clear for the ATO, again, you don't want to leave yourself open to the whim of the person that you get in that review or audit on that day, whether or not they're having a good day or they've just had a coffee.
Yep.
You want to give them all the easy info, very, very like
clean, right?
unspeculative, clean, nice and clean, and they're not going to question you.
Yeah.
Then.
I think one of the things on this as well, guys, like that I always say to people, it's like when you equity release something for investment, don't touch it just don't touch it for anything else other than investment. And it's like when you have maybe an equity release or whatever against the house, and you go use it to buy a car or whatever, like personal expenses, that's one thing. And just like whatever, if that's for that, then that's for that. But when you're doing it for investment, have it as a completely separate loan. So it's just very clean, very clear cut. You know, and you don't have to, for one, it's a lower cost for you guys, right? Because then you guys don't have to like working out the taxes. You don't have to go through and try and work it all out and calculate and everything at the same time. It's very clean and clear cut for them as to what they're being able to write off and claim back as well.
Absolutely.
And not only will it cost you less, but it'll give you a happier accountant. Yes, we get paid for it, but we don't want to do it. We're busy enough.
You're busy enough.
We don't want to sort through this.
Piss at 4 p.m. on a Wednesday, Arvo. Keep them happy, guys.
Yeah, exactly right. Yeah, we can't. If we have to focus, that means we can't drink red wine whilst we do your tax return. And there's
how am I meant to finish this cocktail off if I got to sort through these receipts?
Mate, you and your martinis, mate. I don't know what's going on over there. I don't know what's going on. Boys, I've enjoyed this so far. It's a good app. We're going through a lot of good stuff here. But the whole reason for this app was obviously tax time and some nice tips that you can give us as well. I would love to know the tips. For one, okay, we've gone through a few of the most common things that we've seen here, the biggest mistakes, some big mistakes we kind of see from this front as well, and miscalculations. But what are the biggest write-offs and stuff, claimable items that you see people miss over these long terms? Depreciation, obviously, is the big red flag. It was the biggest one that I missed very early on in the journey as well. Thankfully, I was able to do the claim backs, the same as you guys have gone through the examples there as well. But outside of that, guys, like what are the biggest things you guys see people missing or not understanding that they can kind of go down that avenue and claim this item or that item as well?
Yeah, I think one of the big times someone needs to work with their accountant very closely is if they're selling a property or an asset, because it's really complex, and if it's done wrong, it could cost you a lot of tax that you didn't have to pay, or later down the track, the ATO could come knocking on your door. Basically.
So what sort of things are you talking about there?
Yeah, it's a double-edged sword. Okay. So you've got to make sure certain things like the depreciation that you've been claiming on the building cost, that actually has to add back to the gain you've made on the property, as an example. Another thing is having a record of the stamp duty and the settlement statement and the contract of sale from 15 years ago when you bought the property. No one thinks about that when they buy the property. And the accountant doesn't need that info at that time necessarily. They need the settlement letter, but they don't need the contract or the stamp duty or the legal fees, the conveyancing, the pest and inspection.
So just to cover that again, guys, settlement statement on settlement, because obviously you got all your costs there of your upfronts that you paid on the upfront, like your stamp duty, your legal fees, it might be land titles, insurance, all that sort of stuff, which 15 to 20 years from now, you're probably going to struggle to find. But also your building and pest costs, any of those initial establishment costs. If you've used a buyer's agent, that's obviously added to the capital base of when you sell. You should be keeping all this stuff in a folder of like initial setup costs of this property. So then you can claim it at the back end if you ever sell it, and you don't have to be pulling your hair out or accidentally miss it, right? And I think that's the biggest thing you're saying there is people miss it.
Yeah.
Definitely.
The amount of times that I've had someone come to me and say, "Yep, I've sold my investment property. Here's the documents from the sale." And I go, "Great. Where's the documents from the purchase?" Like, what do you mean? I'm like, "Well, do do you want to pay tax on 100% of everything, or should we deduct some of these things off?
Generally a bit of a blank stare at that point. And then you're going through the list of things, and pest and inspection. You can sort of be like, that's probably $400. So you've got a receipt for that, right? And then you get to stamp duty. And you're like, did you pay stamp duty? They're like, yeah, I'm pretty sure I did. Yeah. Of course you did. You just don't have a record of it. Yeah. It was probably $15,000.
Yeah, man.
So yeah, I think that's a really key time to not get wrong. But also then let's use the scenario of someone, it gets very complex very quickly. Yeah. Someone who bought a property and lived in it for a while, but then moved out and maybe rented and then bought another property to live in. Yep. You've got to actually choose which one your main residence is. And you could actually sell the first or the second property you purchased and use that as your main residence, depending on the scenario around your situation. And this could make a massive difference to the amount of tax you owe, definitely in that year, because you could push the tax back until you sell the second property, which you may never sell. Or you may have one property that makes a bigger gain than the other, which of course you'd prefer to pay the tax on the property that's going to make a lower gain, right? So that's a unique scenario, but it's a really good example because you don't realize what your scenario is until you sit down and look at it with an expert that's going to ask you these questions.
Yep. That's a really great example because let's just elaborate on this a little bit. You own an investment property that you live in. Sorry, not investment. You live in it to start with. Yep. Then you move out and you rent it for, say, 2 years. Yep. After 2 years, you buy a new house to live in and you move into it. And let's just say 3 years later, you sell the first one. Yep. So during that time, there was a 3-year period where you owned both properties. Yep. Under the 6-year exemption rule, that first property could be exempt from capital gain the whole time. But if you choose that after you sold it 5 years after moving out, the 3 years in which you're claiming that was still your main residence, that first new property is now no longer exempt from gain. Yep. And so the fun thing with this is the way you value each of those properties is actually slightly different then as well, because you can take you've either got to get a valuation done at the date that it started gaining income, or if it was an investment first and then became that property, you then do it based on time that it was investment versus not. So it can get real complicated. Just in a very common scenario that probably happens.
That scenario I've come across 2 or 3 times in the last couple of years. Yeah. And there's been examples where initially I thought a client may owe 70 grand on the sale of a property that they made a gain. But then later we were actually able to work through it. And based on, there were some repercussions later, but for that year, they didn't owe any tax. Which is pretty crazy.
And
really.
you might choose to make that first property, if it's made a significant gain, you might choose to make that first property your main residence for that whole time because you're planning on living in this new one for the next 30 years. Yes. And if 3 years of that 30 happens to be taxable, then that's going to be a very small amount of the overall gain.
Yeah. It's 10%.
Yeah.
So 10% of your gain in 30 years' time
100%.
is going to be taxed, and it could be 50% of that 10% anyway you pay the tax on.
It's really important.
And you don't have income then. You could be retired.
Yeah,
so
100%. Look, I think it's so much more important than a lot of people realize because and working with the right person that understands this as well. Because I remember this actually almost happened to me when I sold my first property in 2017, and my accountant was sure, like this is the previous account I used to use, she was sure that I didn't have any sort of exemption period during that, and she was trying to slug me with full CGT on it. And I went to a couple of others, and they were all saying the same thing. And then eventually, I got an accountant who was just like, "No, like they're wrong. Like because I was just lucky. I just read so much information, and I read about this before, about that. Like obviously, it's up until you move into another place, and then that ticks over into the new one. So it was like 4 years there, and it was 4 years of pretty rapid growth in Sydney. So like it was well, the last 2 years of it was, and it was like I was going to be. It was an extra 54,000 in tax that I was going to pay. That's how much I was able to get off it. And for me at that time, man, I was making like 70 grand a year. So like my post tax was like 55, 60 grand a year. It was almost my entire post tax amount. And these guys that didn't know what they were doing, these accountants, these previous accountants, didn't know what they were doing. Man, they're almost going to cost me that. Like it was a huge amount. So it's so important you're working with someone that understands this stuff properly.
Yeah, and it's possible that those accountants knew what they were doing, but the trap that accountants can sometimes fall into is they're like, I need to be able to do this tax return within a budget of $300. Because otherwise that personal tax return client is not going to be happy. Isn't that crazy if you could potentially save 70?
Yeah.
Because the issue is potentially you can't save 70 grand in tax, but then you're not going to want to pay $1,000 for me to tell you that I verified that. But that's the wrong attitude to take. So you pay what you get for. If you're going to pay peanuts, regardless of who it is, if they've got an hour to spend on it, they're going to give you an hour's worth of advice on that too.
For sure.
So that's an interesting takeaway that I've had previously as well, trying to fit things into small budgets.
Yeah, man.
You're never going to give the best advice.
It makes sense.
In that scenario.
It makes sense.
In terms of just other general deductions for your property, though, it's everything that people should know: your agent fees, your council rates, your insurance, gardening, pest control,
Body
repairs,
that sort of stuff.
body corporates, land tax if you pay land tax, all those types of things. Pretty much if you're spending money on your property, it's likely it's a deduction, unless you've bought an asset. Or you're talking about the cost to go inspect your property, which is no longer a deduction.
A couple of other interesting ones. Travel to your accountant is deductible. So maybe get an accountant over in London or something. I think there's probably reasonable limits to that.
Is there still a cap on the tax advice? Remember, there was talk a couple of years ago. They were going to cap
the amount you could pay for accounting fees.
Oh, really?
Yeah, and it was like $5,000 for an individual tax return or something.
This was when Shorten lost the losable election, I think. He was going to unwind the franking credit refunds.
Yeah.
And I think he was threatening the negative gearing.
Mate, that's what lost it for. Dude, 100% was that negative gearing, man. Like trying to take that away from all these Aussies that have been holding on to properties for that long. It was that. Man,
there was big changes.
It was game over.
And then ScoMo came in. So we all won. So I think like just to sort of revisit a couple of things there as well. Sorry, I know I'm a tax nerd here,
You're right.
You've got me started now. So
are we back in the tank? Are we back in the think tank?
We're back in Tim's think tank here.
Tim the tank.
He's built like a tank. Check out the video, guys. You got to check this thing out. It's massive.
Yeah. One of those hips cool new slim tanks. Yeah.
I was just going to say, like, capital gain event again. We're talking people who have large portfolios. They're going to be selling properties quite regularly. Probably. So if you know you're coming into a big gain, perhaps there's some things you can do in that year as well to try and claim a bigger deduction. So a really good one is the carryback of your superannuation limits. Okay. So each year, particularly people who may be making investments, they don't have extra disposable income that they can be putting more into super. That's actually tax deductible if you do that over and above what your employer pays into your super. But most people don't know there's a $27,500 cap that you can go up to each year and put money into super and claim a tax deduction for it. So if you're earning $100,000, your employer is only putting $11,500 into that cap at the moment. And you've got $16,000 or so unused. That's just for 1 year. Yep. So if you know you're in for a huge capital gain, you could actually go, well, I'm going to sell the property in January. I'll get my cash in March, and then I'm going to put 60 grand into super, which is the unused caps I have from the last 5 years. And that could save you 30 grand in tax potentially.
That's mad. And I think the other cool thing about when we're releasing this, right, is this is something that, like, if someone has sold something this financial year and they're coming up to it and they've got the big bill that's going to be coming up because of it, but maybe their serviceability is a bit average because of where interest rates are right now. most people would know, obviously, from an SMSF perspective, it's a different lending environment, right, that we can work within as well. And so if you can offset that and save yourself 30 grand in tax and put in, especially if you've made a big capital gain, or maybe you had a big year in your job or whatever, and you're going to clear 300, whatever, right? If you can save it and put it in that avenue instead, but then have that as now working capital that I can go do a deal in SMSF, that could be a really cool vehicle to then kind of keep building from that side as well. So, man, I think that's a really prudent time to be kind of listening to that as well, because these guys have got a few weeks to either reach out to their accountant or to you guys or whatever, and create a tax plan around this to then minimize it and maximize potentially that other avenue.
Because the cash does need to be in your super fund before the 30th of June.
Okay.
So we're telling
not the payment.
Zero,
they need to have received it.
Xero, the accounting software, sent around an email saying you should probably, as an employer, send your super off by the 18th of June if you want to claim a tax deduction for it. By landing before the 30th.
But there's a few administration things around that as well. If you're putting money into your super, obviously you're not going to be able to access that money back. So make sure that's the right plan for you going forward until you retire. But then also you've got to submit a form with your super fund to say, I intend to claim this as a tax deduction. And then they send you a letter back that says, yep, no worries. And all that means is that they'll tax it appropriately on their end. So that contribution still gets taxed at 15%.
Yeah.
But it's just
if you were going to be in the 47 tax bracket, 45, 47, whatever tax bracket, because you've done a big capital gain, then obviously that could be a good way to offset. Well, it's 30 cents, right? 30 cents in the dollar difference.
You're clearing 32 cents there. And it's going to feel, because you don't really feel the pain of paying tax and super, that comes out of the super money. So it's going to feel like you are saving 50% of the amount you put in.
One thing to be aware of is Div 293 tax. I don't know if you've heard of that before, Sam.
Please, man, run through it. Go for it.
Yeah, if
I hate this one, Div 293, it's the worst.
Once your income goes over a certain amount, you start to, and this includes your income and your super contributions. And that's why I mentioned this now. If you're making additional super contributions and it pushes you over this cap, just be aware of it.
True.
But essentially, it's your super fund gets taxed an extra 15% on the contributions that have caused that amount above that limit. The calculation for it's a little bit complicated and annoying, so I won't run through it because it's not necessary. But just be aware,
it's a thing.
It's a thing, and I think it's 250.
Yeah, and your accountant generally won't really tell you about it unless they're really special. They're like, be aware, Div 293, because there is a box that they can probably push when they're preparing your return to spit out how much you might owe for Div 293. But the ATO just sends you a letter in the mail. They're like, hey, good news. you earned over 250 grand between your income and super.
Yeah. You're going to get taxed a little bit more.
I think the important or the takeaway I'm getting from this, guys, is work with someone that understands this stuff. And then you're not
it's
gonna
complex.
Exactly. And you're not going to make the mistakes, right? And I think I'll even go back a tiny bit before as well, exactly what Dan said earlier, in the sense, guys, of like, it has to suit your strategy as well. So like, we're talking if you're going to have a massive surplus, but maybe borrowing is going to be average anyway, but you're going to be able to pull some equity out maybe in 12 months, whatever the scenario is, or maybe you're sweet on both sides, but that's going to allow you to get another property in super or a property in super and start kicking that off as well. It's always got to work in within the strategy. And it doesn't need to be the full 60 grand, but maybe it's 15 or 20 or 30 or something like that, which helps get you over the line for the first deal. But I think understanding the strategy is a really important piece. But then, exactly, you boys are saying there is if the opportunity is there to save yourself a decent amount from that side, it's sometimes it's very worthwhile doing. Guys, as a final thing to sign off, I've loved everything about this, guys. It's been a good bit of fun. Like any advice you would give for tax planning into next year, right? So we're even in terms of planning your portfolio, is there anything you guys would throw out there for guys to, guys and girls out there listening to this, to be able to kind of even manage their stuff better moving into next year, so they're not coming to you with a box of receipts every year, to plan this thing a bit better? Is there any sort of advice you'd give around that side to maximize, the ease of doing your tax return? Because as portfolios get bigger, they're a bloody headache, right? So what would you recommend around that?
Yeah, I think you've got to have good records. We've covered that, because if you don't and you get audited, then if it takes 2 months to respond, you're not passing that audit. I can tell you already, regardless of if you did dodgy shit or not.
Just be organized. There's software out there you can use. There's, the simple Excel spreadsheet goes a long way. But there's actual software out there now that you can manage these things on as well. If you're someone who has many investments, treat it like a business.
Yeah.
get an accounting software.
Absolutely.
Start tracking your income and expenses, and categorize them by property, and just be a little bit more sophisticated with it if you are that person.
So true. And you probably are that person because if you're already talking about strategy, you're going to be reviewing your strategy regularly. Why wouldn't you want detailed figures as to how much income and expenditure you have per property at the touch of your finger? So I think that's a huge one. The other thing probably worth noting right now, moving into
real quick, just before you jump on from that, guys, that kind of even goes in. If you're detailing it from the very start, it's almost somewhere where you could log that stuff we're talking about. That's at the very start of owning that property, like your settlement statements,
True.
your PES, all that sort of stuff. If you're keeping all that in one place, when you get to the back end, whether it's in 5 years, 10, 50 years, and you sell this thing, if you sell this thing, you've got all of those records there in that one place rather than trying to find them. And it might be like you guys say there, Excel spreadsheet per thing, and you've got the initial setup costs, and then you got bang, all right, year 23 and 4 and 5, and and so on and so forth. So I think that's good, guys. I like that.
True. Yeah, definitely. No, that's a really good one. And I think just heading into the 2025 financial year, tax rates are dropping from 1st of July. So if you do have a large income event that you can push back into the next financial year, then definitely do it. Because if you're earning, I think it's about 140, 150 in taxable income, then you save about $4,000, $3,000 to $4,000, which is per person. Makes a big difference.
Yeah, 100%.
Yeah. So the more deductions you can bring forward into this year, the more income you can push back into next year is always better. And also you get an extra 12 months without having to pay the tax if the income doesn't come into this year.
Which is always good, right? If we can put these things off, why not do it?
Inflation's a thing. Yeah, exactly. Yeah. It'd be worth less than 12 months. So
my final sign off, guys, for even planning for next year as well is guys, listeners, make sure you're putting all your stuff through. Like my favorite thing is putting everything through a property manager, right? So like if you can put your council rates through them, if you can put your water rates, insurances I like to handle myself, but especially council, water, if you've got a unit, your body corporate, all that sort of stuff, put it all through them. Like if they're getting paid quarterly or whether it's annually, quarterly, whatever it is, put it all through them, because then once you get that back at the end of financial year, that's all in one place with all that information. And a lot of the time, like it just makes it so much easier. I can tell you when the portfolio starts getting big, it's one of these things you don't want to be trying to track all this stuff because you'll miss it or you'll lose it, or then you'll have to go and try and chase these things, and it becomes an absolute nightmare. So get out of that, avoid that as much as you can. The other thing, guys, is anything else you're thinking of, maybe before end of financial year. Like if you guys, maybe have only found us in the last 6 months and potentially you haven't heard Magic Mike's Poddy and it only got brought up today with the guys, and things like depreciation reports, or maybe you've put off depreciation reports for a bit. And, some of these bigger ticket items, as you're getting closer to tax time, what I always used to do, especially when I was very much a lower income earner and I was trying to save as much as possible, I would save everything until June, and then I'd order everything in June. It might be depreciation reports. Maybe I needed to do, termites barrier spray or something, or fix this or that, or whatever. Maybe some, get it defined by the boys, but repairs that you could maybe write off almost immediately. These sorts of things, if you can put them all off to the back end of end of financial year. I used to literally do this with a handyman on different properties. I'd have these maintenance stuff come up over like 3-6 months, and I'd leave it and I go, I don't have the money. Wait until new financial year and I'll have it. But I'd actually do it in June. So then all these little, fixes that I had to do on the property had to get done. Like I could write them off again straight away in July or August when I do that return.
Brilliant.
So, and probably like even your big ticket items, like for you guys that haven't bought school or property yet, nice big one that you can obviously, that's our education course, you boys. Nice big tickets like that, big things like that.
Deductible.
If you're right if you're right there at the back end, and you're able to write this thing off straight away, there's one of these things, guys, where you can load all these things up and then write them off straight away. That's perfect. Like that's where you can get it added back in straight away, get that tax return straight away, and then obviously have that kind of almost paid back to you almost immediately. So, but boys, anything to sign off? I've honestly loved this, guys. There's been a lot of good stuff in here. There's been some good banter, which is always worthwhile. Always makes it fun and enjoyable. Anything else you boys want to sign off with?
I think, I just want to say, like, you made a very good point there, and particularly this year, if you can bring forward repairs you're going to have in the next 6 to 12 months and pay them out this June, you will get more tax benefit from doing it in July because the tax rates are dropping, right? True. So, so bring forward those expenses.
Yeah, and I would say a shameless plug for our podcast. If you're in small business, Go listen to the podcast.
100%.
Two Drunk Accountants, wherever you find podcasts.
Yeah, because we didn't even delve into that. So business owners who want to buy property and getting cash out of your trading entity to try and do that. It's again structuring, but it is possible. And you just need to think about your scenario and get the right structure in place.
Definitely. I've listened to a couple of those eps as well, boys, around that stuff. Like even on your poddy as well, and having a good listen to it. And there's some good stuff in there, guys. And I think anyone out there, the small business owners especially, like this is what these boys kind of specialize in, specifically within the podcast and like different things within that. We won't call them loopholes. We'll call them ways of maximizing your position. All right. That you can obviously, worth listening to. And if you haven't been through it before, you're early in a business journey potentially, or maybe you've been doing something forever and your accountant's 50 years out of date. There's these things in there that, that these boys obviously go through and dive into as well, that you want to be maximizing everything you can when it comes to tax, right, guys? Like, fuck, we don't want to pay more than we need to pay. So I think it's really important to understand this stuff. And even if you can figure out how to use it towards being able to invest, sooner or for more or whatever, having these little weapons in your arsenal. So I'm glad you boys gave the old shameless plug for it, guys. Make sure you go check out Two Drunk Accountants. I've had a good laugh with you boys today, and I know some of those episodes over there are pretty funny. Yeah, Tim's think tank, boys. Like what a crack that is. So, I love it.
I should have come with a Tim's think tank, but I made one up on the spot. So that's all good.
Next time you can prep it up for next time. All right, boys. Thank you very much for joining us, listeners. Thanks for tuning in. I hope you enjoyed the episode. If you did, make sure you send it on to someone else you think might also enjoy it. Maybe someone needs some tax planning advice, or they take some value from property investing, tax planning, all the rest of the sort of stuff that we dove into with this episode. I hope you enjoyed it, and I will see you all next week on another episode of the Scouting Australia podcast.